Did you know what's the difference between an RRSP and a LIRA account? You'll be surprised very few know about the difference between RRSP and the lock-in retirement account, or LIRA for short. Hey, welcome back, this is Thomas. In this video, we'll dive into the two accounts so you can plan better for your retirement. As you probably know, both the RRSP and the LIRA are registered accounts are designed to encourage Canadians to save for retirement. But if they both to serve the same purpose, why not just get rid of one or the other to avoid confusion? And that we must understand the origin first. Around 17 years ago, prior to 1957, there's no such thing as the RRSP. And it was right after the World War II, the baby boomers start to peak. People lived longer, so they were looking into their retirement planning. And please understand at that time, it will work for a company, the company will promise to take care of you through the defined benefit pension plan. However, as people lived longer and longer and the stock market was so volatile, employers didn't like to bear the risk of taking care of all their retired employees for the next 20 to 30 years. Therefore, Canadian government promotes RRSP, which promotes Canadians to take back the responsibility to save for their retirement. Meanwhile, for people who want to change jobs, they are free to take their pension plan away with them. However, pension is designed for retirement only. So for you to move it out of the previous employment, you must first transfer it to a LIRA account, which stands for the lock-in retirement account, which you cannot access the money until age 55 or older. You can open an RRSP neither with the company that you work with if they offer one, or you can open one in any of the financial institution. If you earn income and file a tax return in Canada, you can contribute to an RRSP. The main advantage of an RRSP is your contributions are tax deductible. For example, if you make $100,000 a year, your average tax bracket is around 30%. So in theory, every dollar you put into your RRSP, you save 30 cents. And in a perfect scenario, you get those 30 cents back in tax return. So the more that you make, the more powerful RRSP can become. And once you open an RRSP, you have the full control of where you want to put that saving is. You can put it in a savings account, or you can invest it in a stock, mutual fund, ETF, and etc. But obviously, you must be fully responsible of your investments. In addition, you can design your own contribution schedule as well too. For example, you can do a monthly contribution, a lump sum contribution as well. The limit of your RRSP contribution is determined by the 18% of your previous income, or around $30,000 threshold, whichever is lesser. Any room that you didn't use in the previous year, you can bank it for next year. And lastly, you can withdraw it at any time, but it will be 100% added to your personal income. So if you're making $100,000 already and you withdraw additional $10,000 for emergency, then your total income for that year will be at $110,000, so that $10,000 will be taxed at 30% and more. The goal is to take it out when your income is lower, for example, neither in your retirement or when you need to take a break from work. Now, before I talk about the LIRA, I want to first talk about the pension plan. For defined benefit pension plan, it's very similar to RRSP. It's also designed for retirement. It gives you the same tax deduction as RRSP. It also shares the 18% contribution room with RRSP as well. It's tax sheltered growth, and when you take the money out, it's also 100% taxable. On the contrast, you don't get to control where you want to invest, as they decided everything for you. In return, they will give you a guaranteed monthly benefits no matter how the stock market runs. And certain people like that as they are not good with their money management. Like I mentioned before, once you quit your job, you can transfer your pension to LIRA. So think of LIRA as only an account that holds your pension plan. You can consolidate multiple of pension plans. However, you cannot, I repeat, you cannot contribute any further for your own money into this account. Once the money is in LIRA, just like in RRSP, you have the full flexibility to choose where you want to invest, but also this will be at your own risk. The account will be locked until you hit age 55, and after that, you have the option to keep it in there to grow, or you can unlock 50% of the money into the RRSP and withdraw it in the later years. And then for the rest of the 50%, you have the option to turn it into a life income fund, or LIF for short, which I will explain it later. Now, let's look at the key difference between an RRSP account and a LIRA. In terms of functionality, RRSP is way more versatile than LIRA. For example, RRSP's main purpose is to help Canadians to retire better. However, in case you need money to buy your first home or you need money out for your education, then you can access the RRSP tax-free no matter when. While RRSP are meant for retirement saving, individuals can withdraw funds from the RRSP at any age. If you fall short for any reasons, RRSP can be used as a backup. However, for LIRA, the only time you get to access this money is when you hit 55 years and older. There are few exceptions where you can unlock your LIRA early. However, they are very difficult to meet. For example, you are facing a financial hardship, such as being not able to make rent or mortgage payments, or you are permanently leaving Canada, or you are diagnosed with a terminal illness, and you can only do it in one account per year with one category only. Another key difference is the spousal contributions. RRSP allows a high-earning spouse to contribute to the RRSP of a lower-earning spouse. This strategy is used for income splitting later on, potentially resulting in a lower combined tax liability in retirement. With LIRA, unfortunately, there isn't a spousal equivalent. In short, there's not much difference at the saving stage, as they both get tax deduction, tax shelter growth, and you get to choose where you want to invest. The main difference lies on the withdrawal phase. Let's say you're age 60 and you're retired. You need to withdraw money from the retirement account for living expenses. For RRSP, you can withdraw it at any time. There's no limit of how much you want to withdraw. Keep in mind again that for all withdrawal will be 100% subjected to your income. And for our beloved CRA, worries you spend all the money and have no money to pay taxes, so therefore they set a rule called the withholding tax. If you withdraw less than $5,000, they will withhold 10%. 20% withhold between $5,000 up and $15,000, and anything more is 30%. So in other words, if I need $4,500, I actually need to withdraw $5,000, and that $5,000 is 100% taxable. Well, you have two ways to semi-bypass it. One, you instead of withdrawing a one-time of $15,000, you do it in 3 microtransactions to lower the withholding tax. Or you can convert your RRSP to RIF, Registered Retirement Income Fund, and once you do it, depending on the age limit, for example, if you're age 65, you can withdraw 4% without any withholding tax, but anything above 4% is still subject to the withholding tax rule. And again, remember, even if you don't pay the withholding tax, the money withdrawn are still taxable. LIRA, on the other hand, you can switch 50% into the RRSP, and the remaining 50% can only switch to a life income fund. Similar to RIF, there's a minimum withdrawal amount per year, which means you have to withdraw that amount every single year and you don't have to pay any withholding tax. However, for LIF, there's a maximum amount as well, meaning you cannot withdraw anything more than the maximum amount in that year. For example, at age 65, your minimum is 4%, same as RIF, and the maximum is 7.38%, and that's the maximum amount that you can take. And why the cap, you may ask? Because LIF is designed to mimic a pension plan, so they don't want to give you too much flexibility to you. This means even if you need money, it most likely won't be accessible to you. And what happened to your RRSP or LIRA if you pass away early? For RRSP, if you still have leftover RRSP when you pass away, you can roll over to spouse RRSP for free. If you don't have spouse, then the named beneficiary will receive the money. However, CRA will take that portion first, as they assume you took out the money from your RRSP at the time of death. And similar to RRSP, LIRA shares the same fate, except that when it rolls over to spouses, the money is unlocked, so it can go to your spouse RRSP instead of another LIRA. And if there's no spouse, or if the spouse waives their rights, the funds can be directly to named beneficiary or deceased estate. However, in such scenarios, the funds are taxable as well as same as the RRSP. Now let's move on to what can happen if you start a new career. It is important to ensure the pension from your prior job doesn't fall by the wayside. If you're departing from a job that had a pension plan, you can transfer the pension's value to a LIRA. But initiating any transfer is essential to grasp whether your pension is vested. It's worth noting that not all pensions vest immediately, so understanding your entitlement is crucial. Moreover, depending on the specific of the pension plan, you might be presented with alternatives beyond merely transferring to a LIRA. So, as we all know, life isn't static, and neither should be your retirement planning. As always, there are tax implications to consider. It's highly recommended to seek advice from a financial planner or advisor. They can offer personalized guidance tailored to your situation and ensure you're making informed choices aligned with your retirement goals. Alright, I hope you found this video useful. This is Thomas. Thanks so much for watching, and I'll see you in the next video.